where you are. This is the first of a two-part series on required minimum distributions. We'll have part 2 next month on Wednesday, October 5th, where we'll talk about minimum distributions after the death of the account owner. For a more detailed overview of lifetime required minimum distributions, I'll refer to them throughout today as RMDs. Please contact Lisa for the Think About It newsletter. She'll tell you how at the end of the call. Now I'm going to spend 15 minutes or so today dealing with the most common RMD questions that we get here at Advanced Underwriting Consultants. But before we jump into that, let me ask the obvious question, why are minimum distributions required? Well, I think the reason is that Congress, the President, and the IRS don't want folks to be able to defer income taxes forever on IRAs and pension accounts. The day of reckoning must come about at some point. And so when the distributions are taken, generally that's when the income taxes are paid, and that's when the government collects its money. Now, I think it's important to remember as we go through RMDs, required minimum distributions, that these are minimums. A taxpayer can always take more out of the account than the minimum required. But for many of our best clients, the money in the account, they want to defer income taxes as long as possible, and that's why we talk about RMDs. So when we talk about RMDs, I think it's important to understand a particular concept, and that is the required beginning date. And for IRAs, the required beginning date is really pretty simple to understand. The required beginning date is April 1st of the year following the calendar year in which the participant attains age 70 and a half. So the year after somebody turns 70 and a half, April 1st of the year after, that's the required beginning date. That's the deadline for taking the first RMD. Now for pension accounts, the required beginning date is April 1st of the year following the taxpayer's retirement, if two conditions are met. The first condition is the plan is sponsored by the employer for which the participant is employing, from which the participant is retiring, right? So you can't, a still working person can't defer RMDs from a former employer. It's got to be from the employer from which they're currently employed. And then the second thing, and it's sometimes overlooked, is that the participant cannot be a significant owner of the company. You know, so you can't have 100% owner of one of your closely held businesses put in a 401k, dump all the IRA money that they've got into the 401k by rollover, and expect to be able to defer RMDs because the person's still working. That won't work. If they own more than 5% of the company, the required beginning date is April 1st of the year in which they attain age 70 and a half, regardless of their working status. And so subsequent RMDs are due by December 31st of each year. Now, there are 2 points that kind of recur with regard to people who call us up and ask RMD questions. First, if an individual decides to defer the first RMD to April 1st of the year after they turn 70 and a half, for example, they'll be required to take 2 RMDs in that calendar year. Now here's an example. Let's say Jane turns 70 and a half in 2016, but decides to wait until April 1st of 2017 to take her first RMD. If she does that, she's going to have to take her RMD for 2016 as well as her RMD for 2017 in calendar year 2017, and she'll pay income tax on both of them in 2017. And because she has to double up on those, it may be smarter for Jane to take her first RMD a little bit earlier, say in December of 2016, so that she can deal with the income tax results for both of those RMDs in separate income tax years. So that's point number 1. Point number 2 is that simple IRAs and SEP IRAs are treated as IRAs rather than pension plans for RMD purposes. And so if you've got a participant of a SEP IRA even if that participant does not own the company, the RMDs from that SEP IRA have to be taken by April 1st of the year following the year they get to age 70 and a half, even if they continue to work past age 70 and a half. And that sometimes leads to the circumstances where they're taking RMDs from a particular account and also still contributing, or the employer is still contributing to the account. That happens all the time. So SEP IRAs, simple IRAs, are treated differently from pension accounts with regard to the required beginning date. And one other thing I think that's important to understand is that Roth IRAs and designated Roth accounts are treated differently, not only for certain income tax results, but also with regard to RMDs. So for a regular Roth IRA, minimum distributions are not required while the original account owner is alive. However, with a designated Roth account, Roth 401k, Roth 403b, governmental Roth 457, those are subject to qualified plan minimum distribution rules while the account owner is alive. And so those rules have to be thought about and respected with regard to designated Roth accounts. It's one more reason why one of your clients might be interested in rolling over a designated Roth account into a Roth IRA before RMDs have to start, so that RMDs can be deferred from what is now a regular Roth IRA going forward while the account owner is alive. If the money's left in the designated Roth account, RMDs would be required. So with regard to RMDs, there are three different tables that are used to calculate RMDs. The one that we're most used to, I think, during the taxpayer's lifetime is the Uniform Lifetime Table. And that's used most often where you've got somebody single or somebody who's married with a spouse who is roughly the same age. You use the Uniform Lifetime Table. There's a separate table, the Single Life Expectancy Table, which is used for beneficiaries of inherited accounts to calculate their RMDs. We'll use some examples of that next month in October's webinar, post-death minimum distribution requirements. And then there's also the Joint Life and Last Survivor Expectancy Table. This table is used much less frequently. It's used when a spouse is the sole beneficiary of an IRA or other pension account and the spouse is 10 years or more younger than the account holder. Why is the table different? The factors for life expectancy are more generous. That is, RMDs can be lower if the spouse is the sole beneficiary account and the spouse is 10 years or more younger than the account holder. We don't often go to the table, but it's important to know, and it's important for you to ask if you're working with clients and you're helping them think about RMDs. It's important to be aware that more generous table might be available if there's a big difference in age between the taxpayer and the taxpayer's spouse. So how do you calculate a required minimum distribution? Well, if you look at the right table and you divide the previous year's year-end account balance by the factor from the table, and the factor you pull from the table is the birthday that the person turns in the year the RMD is due. So let's say Laura's single, her date of birth is October 1st of 44. She turned 70.5 on April 1st, 2015. She must take an RMD for 2015, and her required beginning date was April 1st of 2016. Her factor from the Uniform Lifetime Table for that 2015 RMD is 26.5. If her account balance was $26,500, her RMD would be $1,000. We worked out the numbers to make the math easy. And then her second RMD for 2016 is due by the end of 2016. If her IRA balance at the beginning of this year was $26,200, then her required minimum distribution would be 1,023, 26.2 divided by 25.6. And 25.6 is the uniform lifetime table factor for a 72-year-old. That's how it works. That's how to calculate them. Now, there are a few special rules with regard to RMDs that we get asked over and over again. The first one is, can you convert an RMD to a Roth? It's a nice try. Somebody who is going to take a taxable distribution might want to take advantage of the taxable distribution and convert the RMD to a Roth. And the answer is no, you can't convert an RMD to a Roth because the RMD is not eligible for rollover. Only amounts that are eligible for rollover can be converted to a Roth. So you can't convert an RMD to a Roth. Second question we get asked is, can funds taken from one kind of account satisfy another account's RMD? The answer is only like-kind accounts can have the potential to satisfy RMDs for another. For example, if you've got somebody who owns 2 IRAs, the RMD for both IRAs can be taken from either of the IRA accounts. That's okay. But if you've got somebody who's got a 403B account and an IRA account, you can't take the 403B account RMD from the IRA. That is not allowed. Any conversation about RMDs, I think, has to at least mention qualified charitable distributions. I get asked all the time, how can my client avoid the income tax result associated with IRA RMDs? And the answer is, well, they can take a qualified charitable distribution. That program has been around for about 10 years, but it was made permanent last year. And the rule is that if you've got an IRA balance and you're older than 70 and a half, you can transfer up to $100,000 per year from the IRA directly to charity, and it will be tax-free. And it is a requirement that the distribution be sent directly to charity. If it is sent, it avoids inclusion of the amount sent to charity in the taxpayer's taxable income. Now, you can't also have the taxpayer deduct the contributions. The advantage is that while the charitable transfer is not deductible, it's not included in income at all. And the other good thing is that the distributions can satisfy RMDs. And so if you've got somebody older than 70 and a half who has charitable intent, I think it's always prudent to talk to them about qualified charitable distributions if they've got an IRA balance. This is an IRA-only program. It is not available with regard to other types of accounts. And then the last idea I wanted to talk about is the failure to take RMD question. You know, I get questions a lot. People call up and say, Linus, my client was supposed to take an RMD in 2015. She didn't take it. What is she supposed to do? I understand there's a 50% failure to take RMD penalty. And the answer is yes, there is a 50% penalty if the inadequate RMD was not taken. It's 50% of the amount that should have been taken, which is a really severe penalty. The IRS has the ability to waive some or all of the penalty if the taxpayer can show that the shortfall was due to a reasonable error and that steps were taken to correct the error. It is the taxpayer's obligation to self-report to the IRS that an RMD was not taken. That is done on Form 5329. And the taxpayer on the same form can ask for a waiver of the penalty and has to prepare a letter of explanation which shows that the shortfall was due to reasonable error and steps were being taken to correct the error. That letter needs to be attached. You know, from my perspective, it's the client's own CPA who should help the client prepare the letter. Also from my perspective, if the client's going to ask for a waiver of the penalty, the client should show the IRS that the RMD shortfall was made up prior to the letter being sent, that an adequate distribution was taken, even though it was late, before the letter was sent, because that to me shows the client understands that the client should have clean hands in asking for relief. Now, this isn't a guarantee for you, but my understanding is that in general, the IRS routinely grants relief if the taxpayer follows those steps and has a reasonable explanation for why the RMD was missed. So it's a good reason for you to be proactive with your clients with substantial IRA or other qualified plan balances who fail to take an RMD to help them fix their problems. So in the RMD world, there are some ambiguities. I just point them out to you so that you're aware of them. First one is that if you've sold an IRA that is annuity-based and the IRA has an income rider, there's some uncertainty as to exactly how the income rider needs to be taken into account when calculating somebody's RMD obligation. In the past, my anecdotal experience is that some carriers simply ignored the value of the income rider in calculating RMDs for those 70.5 or older. I think that's changing in our business. You need to be aware of it. You need to check with your annuity carriers to find out how it is that they're taking the income rider into account for the purpose of calculating an RMD. And then there's also another ambiguity that comes up on a recurring basis. I pointed out as well so that you know, and that is, let's say the client has 2 IRAs, each with a $100,000 balance. The client decides to annuitize one of the IRAs completely for a 10-year period certain, with the intention that the SPIA payments will go not just towards satisfying the RMD with regard to the IRA that was annuitized, but also with regard to the other IRA. And that makes a certain amount of logical sense that that technique should work, but based on the rules and the Treasury regulations, we're not sure that it does. And so it wouldn't be the kind of thing that I would recommend that you help a client do unless the client's own tax advisor understands the risk and believes the risk is worth taking. So both of those issues are things that you might ought to be aware of as you help your clients think about minimum distributions. And so minimum distributions are not something that can be ignored. They have to be taken from just about all kinds of qualified retirement plans. Roth IRAs are one exception. They have to take RMDs annually and correctly in order to avoid the 50% onerous penalty. And one of the good things we can do is help clients think about and plan for RMDs. We hope we gave you some information that you can use today. Tune in next month for Part 2, RMDs after the death of the account holder. Thanks for joining us. And Lisa, would you close this out?
Will do. Thank you, Linus, and thank you all for joining us today. As a reminder, if you would like to receive supporting materials, feel welcome to email us at asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. And finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact me at 615-224-1291. Thanks again, and best wishes for continued success.